for forecasting, and that is, of course, revenues. Right. We can take a top-down approach, we can take a bottom-up approach, or we can actually take a hybrid, which is a combination of both of them combined, right? Top-down means growth relative to GDP. That's a very, very good approach. And I gave you an example earlier. Let's say US GDP $25 trillion, right? And expected to go to 26, 27. And then we can say, all right, what is the automobile market as a percentage of the GDP? So let's say that's 1 trillion. I'm just throwing some numbers here. And that is X percent. And if that percentage remains, then this is the size of the automobile market. And then we can say Tesla as a market share has this percentage. And if that percentage remains, then this is the market size or the sales of Tesla. You could even increase the percentage here, you could increase the percentage here, so you could, play around with this and take some certain assumptions. But you're definitely starting at the top, so this is your top down. We could take a bottom up approach that we could say, okay, how many sales dealerships are there, and then what's the sales per dealership, and then you could work with that. And you can also, of course, use a combination of the two. So growth relative to GDP, very nice approach. You can even say the company will grow at a rate faster than the GDP. Is that something sustainable? Answer is no. It's not possible to grow forever faster than the country you're in. So at some point you will have to stop assuming that, right? But you can assume it to start with for a number of years. As you will learn in the next learning module, that to come up with the value of a company, you need to divide the next year's dividend by R minus G. And this growth rate that you take is the sustainable growth rate. It's supposed to be there forever and ever. And forever and ever, you can't assume that your company will grow faster than the economy it's in. So usually what we would do is we would say, all right, let's assume that this will grow at the next 5 years at a rate faster than the economy, and then it will stabilize. Another point I would like to tell you, which might cause confusion in your mind, is that a company like Tesla doesn't really pay dividends, right? So then if a company doesn't pay dividends, then how do you calculate the value of their share if they don't pay dividends? Well, in that case, you will use something called free cash flow to equity. And that is why you're developing this financial model. That's why you're forecasting all these objects, that you can forecast the revenue, the sales, the costs, and then the profits. And then once you know the profits, you can forecast the balance sheet in terms of your working capital and capital investments, that, okay, how much money I'll need for inventory or accounts receivable or property, plant and equipment, where will I get it from in terms of debt, equity, and then you can work out the cash flow. And then once you know the cash flow statement, you can figure out the free cash flow to equity projections. And even if that is not going to be in the next year that you're going to take, maybe you make a financial model, and once it reaches that stable growth rate after 10 years, let's say, then you use the FCFE of the 10th year to calculate the value of the 9th year, and then you could then discount this back to today, and that is where you get the value today. So this is the big picture, right? It'll all come together when you also complete the next reading, and then you think of all of this in a combined manner, where with your quants material and your FSA material and your economics material, because it's all linked, right? It's all linked. In terms of GDP growth rate is, of course, coming from economics. How can a company keep growing faster than the economy it's operating in? It cannot. That's why it has to slow down. And once it does that, then you can use this formula, which you will learn in the next learning module, to calculate the value. This is, by the way, called the terminal value. And then you can calculate the intrinsic value and then take a decision whether you want to buy this company share or not. And now coming back into the zooming in to projecting the revenue. I just wanted to zoom out a little bit and tell you why we're learning this, right? What's the big picture here? The big picture is not only are you going to forecast the revenue, you're going to forecast the cost, you're going to forecast the profits up until the company is reaching a stable growth rate, right? You're going to forecast the balance sheet, you're going to forecast the cash flow statement so that you can either come up with a dividend projection once the company reaches a sustainable growth rate, or if the company doesn't pay dividends like Tesla, a free cash flow to equity projection. And what is free cash flow to equity? You must have covered that in FSA, right? It is the cash flow that the company is generating, which is available for equity holders. And then you can use that to come up with a value of the company and discount it back to today, and that's your intrinsic value. And then that you can compare to the market price of the company's share and decide whether you want to buy it or not. So that's the big picture. Coming back into the topic at discussion, which is the forecasting of the revenues, which is your first object that we are discussing. Right. We looked at we're still looking at the top-down approach where you said, okay, the GDP is growing, and then let's say this is 25 trillion, 26 trillion, 27 trillion, whatever is the size of the GDP, then I take a certain assumption that, okay, the automobile market is, let's say, a certain percentage of that, right? So let's say the automobile market is of 30 trillion, it's 0.1% or 30 billion. Or something like that, or just the growth in the market is supposed to be that much. And then of that, my company of interest is going to get 1%. So I'm looking at this much growth in my company of interest. So this is basically you take it from the top down and say, okay, this is the entire GDP, this is the automobile market, this is my market share, my company's market share within that market. And then this is the growth I'm expecting. You could also do bottom up. Bottom up could be various different ways of doing it. You could say, okay, how many units am I selling? What's the average price per unit? I could even break it down into different models. So Model X, Model Y, or maybe my other segments like I'm selling batteries, electric batteries separately. I'm selling data, right? So I could have those segment revenues break up. I could do a capacity based measure where I could say, okay, what's the maximum I can produce? Because I can definitely not sell more than I can produce, right? So I could take that perspective bottom up. Return or yield based measure is more relevant for other types of businesses. Let's say, for example, a bank has interest income, right? And if I want to do a projection of the interest income, I would first say, okay, what is the loans, right? What is the deposits I'm going to have, and then how many loans I'm going to make, and then what's the interest I'm going to earn on those. So I could take a return based or a yield based. That interest is, let's say, 5% of the loans I make. So then the question is, what is the amount of loans I'll be making? And then I could use that bottom up approach for a bank if I were doing the projection or the forecasting of the revenues for a bank. You will always have these one-off non-recurring items other than your core business, right? For companies that have a lot of international business, there could be the effect of interest rate change, exchange rate changes, right? So let's say they're selling to a country where the exchange rate moves in your favor, well, then you have the gain, but it's a one-off gain. It's not expected to happen again and again. You could have the impact of an acquisition or divestiture, again, just a one-off thing, right? Or for example, in COVID, e-commerce sales went up a lot, but that was a one-time thing. Or if not one time, but at least not recurring, right? It's non-recurring, doesn't keep happening all the time, happens sometimes. Okay, so what should you consider in terms of risk factors when you're doing this? Obviously, competition. So let's say a company like, coming back to the Tesla example, a company like Lucid is also coming up with electric cars, or your traditional automobile providers are also coming up with electric versions, right? So how's that going to impact Tesla's existing business? Maybe their sales has been growing at a very high rate, but it won't be able to do that anymore because you've got competition coming in. Maybe it's highly cyclical. So if the recession is going to hit, then what will happen? Maybe we've been in a boom so far as an economy, But if we go into the recession, then what will happen? How does inflation, deflation impact it? And of course, technological developments. On a positive note, what if batteries become really cheap, or there's some technological breakthrough in electric vehicle batteries that makes their charging faster or the charge lasts longer or something like that, right? So you need to take all those factors into account. Now we're moving down the income statement. So we're done with the sales. Now we're moving into, okay, what's the cost of the product? And the main point that you really need to understand over here is the fixed cost and variable cost, because sales is going to definitely make that variable cost go up with it, because every product you sell will have certain variable cost in terms of raw material, direct labor, direct material, etc. But then there'll be certain costs like the factory overheads, which are going to be fixed, right? So how are you going to project this based on just sales going up if you don't know the breakup of variable and fixed? And most likely you will not know the breakup, because well, companies don't like providing that breakup because of confidentiality reasons. Because, I mean, if you're going to get to know, then their competitors are also going to get to know. And the accounting standards don't force them to disclose these details. So now there's a trick that we will learn. There's a formula that we will learn how to figure out how much of the change is going to be in variable cost and fixed cost. But we'll talk about that in the end, right? We'll talk about in the end, just before we move on to the summary for the learning module. Let's talk about the some of the other factors first. Number one, let's understand that there is a portion of both COGS and SG&A which is going to be variable and fixed. So for selling commissions will be variable, whereas your administrative office expenses are probably going to be fixed, right? HR department, IT department, all these guys. The problem is the detailed disclosure is not going to be there, right? To be honest, even revenue disclosure is not that detailed. They're not really providing the breakup in units sometimes. They're not providing it product line wise. So already it's less. And compared to revenue, operating cost disclosure is even lesser. So it makes our job as analysts really difficult to be able to make the projections for this. So that is tough, right? And it's not just about coming up with the margin. All of this is not just about income statement projection, that you come up with the gross margin after subtracting COGS and then after subtracting your SG and A to come up with your operating profit, EBIT, and then after interest and tax, you come up with net income. It's not only about coming up with the net income. These things, your cost of goods sold, is going to impact your balance sheet items such as your accounts receivable, inventory, accounts payable. All these working capital accounts are linked, right? Because the sales obviously impacts your account receivable, but your cost of goods sold is going to impact your inventory, how much inventory you need to maintain for that sales, and that depends on cost of that production. And of course, your suppliers you're going to get the goods from, so your accounts payable is going to be linked to that. So once we're done with the income statement and when we move towards the balance sheet and the working capital accounts, and then finally the fixed capital accounts, which is your property, plant, and equipment, and then where it's going to be financed from in terms of debt or equity, we really need to understand the cost dynamics of the business. And it's difficult to do if we don't know the variable cost and the fixed cost portion, because the variable cost will be directly linked to sale, but the fixed cost will not. So this is a big challenge, right? And until we are not done with the balance sheet, we cannot move towards the cash flow statement. And at the end of the day, valuation is going to be based on future cash flows, right? The present value of future cash flows. So we have to do the projection of the cash flow statement. And we can't do that without the balance sheet. And the balance sheet we cannot do without the income statement. So that's why this is such an important area. How can you go about it? As promised, I will tell you a formula in the end, right? which will definitely make things easier. But what else we are discussing over here is that you could try and get as much detail as possible. If you can get the breakup of the different segments or the products and look at the cost dynamics with the sales of those revenues. So if those details are there, in terms of separately the revenue is provided and the separate cost is provided, you could correlate them and see if you can identify some relationship there in terms of a margin percentage or something like that, right? You could look at profit margins of competitors. Maybe if that could give you some insight into the cost dynamics of this business. And then moving to your selling, general, and administrative expenses, they are even more or less directly related to revenue, right? So there'll be a larger portion of fixed cost over here, especially with respect to admin. Here, there will be definitely a larger portion of variable cost because you have direct material, direct labor, etc. And manufacturing overhead is probably a smaller part of your COGS. But here, overhead in selling, general, and admin overhead will be a much larger part. So again, this can also nevertheless be broken up into fixed and variable because your sales is going to have commission and that's going to be variable, right? But everything else is probably just going to be fixed and will not fluctuate with sales, right? Whereas your selling and distribution cost will. So that is your SG&A. Now you take that COGS and your SG&A and you figure out how is it going to impact your accounts receivable, inventories, accounts payable, and other working capital accounts. So that's very interesting. And then you move to your capital investments, that how all of this will then require maybe a need to have a bigger factory or a new factory or some kind of expansion plan needs to be there. And then finally, the capital structure, that where is all of that going to be financed from, right? So are we going to, what's the financial strategy? Are we going to increase the loan that we have from the bank, or we're going to issue more shares? So that details you need to get from the company, and they usually don't provide that information. So you might need to call them up, and I've been in that position, and trying to get in touch with the company's financial managers is a difficult task to do. And even if they do provide you that information, this stuff is going to tie in with your ethics material, that once you get information which is material, right, significant, of interest to economic users, and it's non-public, if they tell you something which they haven't told generally everybody, so then you really need to take your ethics material into account before you use that non-public material information. Right, let's take a break here and then we'll come back and talk about how we can bring about the probability and the likelihood of occurrence into all of this.